The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show that I have a tremendous amount of respect for. I've been super excited about this interview. He is an expert on the bond market and macro. His name is Jim Bianco. Jim, welcome to the Rebel Capitalist Show.
Thanks for having me. All
right, so for my viewers who might not know your backstory, can you get us filled in on that?
Sure, and I might say that I'm a big fan of your show, so I'll do my backstory in 3 steps, right? I came out of Wall Street in the 1980s. I used to work for Shearson Lehman Brothers, First Boston before it was Credit Suisse. I'm originally from Chicago. In 1990, I got affiliated with a bond brokerage firm here in Chicago, which is where I'm at right now, called Arbor Research and Trading. And in 1998, I spun myself off into my own research firm called Bianco Research, still affiliated with Arbor. Most of my research tends to be more fixed income oriented and macro oriented as well too. My audience is largely an institutional crowd. It's largely a fixed income crowd as too. The benefit I have with a firm like Arbor is that while I'm affiliated with a brokerage firm, they don't really position. So, I don't have to go to them and say, hey, that big inventory of securities you have, it's about to go down in prices. They don't have a big inventory of securities. Okay. They don't care, as long as all they care about is like most brokers, just volatility. Just make it go up or down. Just make it do something. So that's been very good. So it's really gotten rid of my conflict of interest as well too. I tend to be more quantitatively oriented toward the way that we attack the markets more than anything else. I've taught myself how to program. I use a lot of sophisticated programming languages as well too. I'm always on the hunt for data to try and come up with a lot of different charts and statistics and ways to show things. So that's my backstory in a quick second there.
Yeah, and I want to be clear, it's not just the institutional investor. I was on your website today. I watched your conference call that you had and that you recorded, and it was just absolutely amazing, but very easy to understand. You titled it the 90% conference call, and I found it absolutely fascinating. Could you go into greater detail on what it was about?
Yeah, that was the cover story of this week's Economist, the 90% economy. And what they talked about in that, and I had been talking about this for several weeks now, is let's say that we reopen the economy globally and we get back to 90% of where we were. Most Wall Street goes, great, we're back to 90%. Except let's put that into perspective. In the Great Recession in 2008, at its worst point, we were still producing 96% of the output that we produced at the high. So you only lost 4%. And that was enough to have the stock market and put a 10% unemployment rate up, create the Tea Party movement, Occupy Wall Street. The Great Depression in the 1930s, at its worst point in 1933, the output was still 75 or 74% of what it was in 1929. And that produced a Great Recession. So what I'm trying to say is, if you tell me that the economy is on its way back to 85 or 90% of what it was before the pandemic, I'm telling you we're running a Great Depression, because right. That is not going to do it. What's going to get us back is 98, 99. Actually, 102 would be the more, be better, is if we got further back than we were before. That kind of drop off is going to be where we are going to have big problems. And that's my big bugaboo with Wall Street right now, is they'll point to statistics like open tables, reservations at restaurants, or the mobility data that Apple puts out from their location services and go, look, it went up. So what? Tell me when it gets back to 98%. Put it to you. Let me stick with the restaurant. If I own a restaurant and I had 300 people a day come through my restaurant, what do I need? And I got my PPP loan and I still have everybody employed. Let's forget about whether or not they're getting paid more from the government to not work, but they're all still employed. I'm probably, if I had 300 people before the pandemic, I probably need 285 or 290 to basically get back to where I was. If you tell me, oh, it's all going well, you're going to get 250 or 220 people when you used to have 300,
Right.
I got to lay off half my staff.
Yeah, especially when your
I'm not
margins are
going to be able to cut it.
5%. Right.
Yeah, or put it to a different way, a 90% economy is a 10% hit in revenues. And especially in a levered economy like we are now with levered companies, you can't survive with a 10% hit. So we've got a long way to go before we get all the way back. And that's been my biggest concern, is that we need to understand how far back we have to come. And most of the statistics show we're not close to that right now.
Yeah, and also you talked about the PPP, and it's one of those things that might have a lot of unintended consequences that the government and the Fed just really aren't thinking through. And the consequences were, if you're a small business owner, using the example of a restaurant, if they take out that PPP loan, they have to pay it back if they lay anybody off. So how does that work when you've got 50% of the volume, or even say 80% of the volume of your customers?
There's another thing too, is that obviously if you take out the loan, you want to get it to be turned into a grant so you don't have to pay it back.
Right.
And the condition is you can't lay off anybody. But if you go out of business, you don't have to pay it back.
Yeah.
So instead of laying off 40% of my employees, and then I have to pay back the loan, I could close my business and then I don't have to pay the loan. So instead of 40% losing their jobs, 100% lose their jobs is what they're going to set up, this perverse incentive with the way that they've done these loans. And I think that that's largely understood, because in the second round of the PPP loans, when they put out the refunding of it, they thought it would last 12 days. It's been 3 weeks and they've hardly put out half the money. I think a lot of businesses understand that. If I take out this loan, it's a temporary thing to pay my workers, but then I can't lay them off if my business doesn't. I don't want to lay them off, but if my business doesn't come back, I can't adjust my workforce except close my business. And I don't want to do that. So yeah, it does set up a bunch of perverse incentives.
Yeah, so they don't want to take on the additional liability and having that burden on their shoulders. So that could put them more at risk of going out of business, or at least it doesn't get the money from the Fed or the government to Main Street. There's still that line in the sand that it doesn't cross. And that was the big problem, well, probably for the last 10, 12 years, is that you've got all these bank reserves being created at the Fed, and they're just only going into financial assets. They're not getting into the real economy. That seems to be always the problem.
That's right, because all the Fed can do is provide it to the banking system, provide it, and then they have to trust or make sure that the banking system turns around and redistributes the money to the parties that need it. And that was the big thing that happened in 2008. We create all these programs, and we trade all these programs to make sure that the banks are well capitalized. And the banks say, thank you very much. You gave me all this money to keep me in business. Well, go out and hand out loans. And the banks are you kidding me? Have you seen how bad the economy is? I have no interest in handing out any loans to anybody. And that bred a lot of social dissent. First you had the Tea Party movement, then you had Occupy Wall Street. And I like to say that, what did they have in common? The Tea Party movement was mad about the bailouts, and they blamed the government. Occupy Wall Street was mad about the bailouts, and they blamed Wall Street. But both of them were mad about the same thing, is what happened. It was just who they thought was at fault for it is where they disagreed. So you see that kind of happening again now in the financial markets all over again. The Fed has put together this endless alphabet soup of programs. They are shoving money into the financial system. That money is helping to support financial prices, but whether or not it actually filters through into the real economy, it hasn't yet happened. Now, we're in early days. Most people that have lost their job are still getting $1,000 a week or thereabouts on unemployment. A lot of them have probably got a raise for being on unemployment. A lot of others have only been laid off for a couple of weeks. There's the talk in the press is about restarting. The surveys say that 85% of University of California did a survey of people that are on unemployment in the state of California. 85% said, I will get my job back once the crisis passes. So the anger's not there yet because there's still this belief, oh, this will go away and this summer I'll be back employed, or I lost my job, but I'm getting as much money in unemployment as I was working. But once this starts to filter through and it takes more time and it isn't working out like you thought, and maybe I don't get my job back, once it's over, then the people start to assess who won, who lost, and where was I in that mix as well too. So I think we're in early days on this thing, and we've got a ways to go.
Yeah, it's when reality replaces hope type of thing. And I know you've done extensive research on the virus, and you were one of the first people with Chris Mortensen and my buddy Eric Townsend with Macro Voices to start doing the thinking and throwing out the data. And I know you took a lot of heat on that, but I'd love to get your opinion on where we go from here.
As far as the government goes with the virus, I had no problem with what they did in mid-March because we didn't really understand what was going on with it. But now that we're into May, we know a lot more, and we've got the Sweden example as well too. And also, I really don't like the way that they've really redefined the whole problem. In other words, it was flatten the curve. Remember right. Flatten the curve? Remember what they told us about flatten the curve? First of all, it produces the same number of cases if you flatten the curve, just over a longer period of time. You're not saving anybody from getting sick when you flatten this curve. What you're doing by pressing it down is making sure if you get sick, there's a hospital bed and proper medical care for you. That's all we're promising with flatten the curve. We did that. It's done. So what are we waiting for? I get, with my governor, J.B. Pritzker in Illinois, or with Andrew Cuomo in New York, when they talk about, or Bill de Blasio, the mayor of New York, saying we have to be locked down till June. What are you waiting for? What magic signal are you waiting for to tell you it's okay to open? And then they keep saying, well, we have to save lives. Well, no, you're not. You're just making it go longer. I mean, everybody's supposed to get it. Herd immunity means you're going to get sick, I'm going to get sick, my kids are going to get sick, but hopefully slowly over time, and there will be proper medical care, and then we can build up herd immunity. But if the answer is we got to stay locked down till we get a vaccine or this goes away, well, it isn't going to go away unless we get a vaccine or we get herd immunity. Quick word about vaccine. Do you know in the entire history of medicine how many coronavirus vaccines we've developed? 0. But this is supposedly going to be the first one that we're going to develop. I'm not a virologist, but I'll just say I see the track record. I know they've been trying for 50 years to put together coronavirus vaccines, and they've never done one. But yet now we're supposed to have this one done in a period of a year. It'd be great if it happens, but I'm not going to hold my breath and wait for that vaccine. So yeah, I think really what we need to do is kind of the Sweden thing. You and I and everybody watching this, we know what we need to do. Social distance, wear a mask, wash our hands. Go ahead, let us go about doing it. And the last thought for you is, I lived in New York City, and I have 2 kids that live in New York City. They're here with me in Chicago now, and I'm very familiar with New York City. If you're going to leave the subway system open, the perfect transmitter of a pandemic, nothing else that you do in New York City can be as dangerous as riding the subway system. So go get your hair cut. Go on out for dinner. It's not as bad as getting on the subway every day. Most of the reason that New York City has got such a problem is the subway system is still open. And that is the perfect enclosed environment of having people, everybody get together, breathe on each other for 10 minutes in this car, and then everybody disperse throughout the city.
Yeah,
you couldn't have found a better way to spread out a virus. And if you're going to allow that, then allow the restaurants to open, because it can't be worse than allowing the New York subway system to stay open.
Yeah, but even if they allow these things to open up, I mean, is it going to matter? Going back to your data where it says, we got to get up to 100%. I mean, maybe that allows us to go from 50% to 65 or 70. And I know for some people it definitely would matter, but overall, I mean, does it really move the needle?
It doesn't move the needle short term, like over the near term, the next year or two. But what it does do is, this gets into my criticism of what the Fed is doing. I've argued, even all the way back to that video I did with Martinson and Townsend back in early February.
Yeah, I remember that well.
There's a pre-virus era and there's a post-virus era. And that this virus is going to be the defining moment of this generation. That there was the world was, and then the world that we're going to. So we're transitioning to some new era. I don't think we are in some kind of state of pause, and then we go back to 2019. We're going somewhere else. So let's open up and let businesses start to figure out what that new era is. Let them start to get going there. So you're right. We're not going to go back to 100%. We're going to go back higher and higher and higher. We're going to come up short, and that's going to be a problem for the economy. But if you ever want to get back to some version of 100%, we need to restructure the economy. And that's not going to be waiting for the White House to tell us how it's going to be restructured. It's going to be you, me, and everybody else figuring out the new rules of the road. So let's get about figuring out the new rules of the road. And that gets me to the Fed. I've got very mixed emotions about what they've been doing on this. On the one hand, I'm a libertarian Austrian at heart. I think that government involvement is always bad, and I believe it's always bad. But also, this is unusual. And if Peter Schiff is watching, Peter, I've been wanting to ask you this question. I'll throw it out to you too, George. Maybe you can give me a feel on it. The government took a bunch of perfectly fine running businesses and said, close, stop doing your business, drove you out of your job, drove you out of your business. The takings clause of the Constitution says you can't do that without compensating me. So in some respects, I'm owed compensation because you took a perfect business and you forced it shut. This is not the free market saying that I've become obsolete or something else has changed. So I get that the heavy government involvement is kind of a payment for that shutting down those businesses. I get the heavy Fed involvement is that. And besides, I don't think they were ever going to sit back and say, wow, look at that. Everything's falling apart, but we can't do anything about it. So, make some more popcorn and let's watch this thing unfold. They had to step into it. Where my complaint comes in is, what is it you're trying to do? And what it seems that they're trying to do is they're trying to say, we want to bridge us to when we can go back to 2019. Well, We're not going back to 2019. Right. If you want to say to people, look, you lost your job, it's a new era, here's some short-term assistance to help you because it came on so fast. And then we could say, but at some point, we got to start the process of adjusting, because the longer we try to hold everything in suspended animation, the longer it's going to take us to get past this. So we need this adjustment process to go on. When you hear companies like Twitter saying that, which they announced yesterday, everybody can work at home now forever. And a lot more companies are saying you can work at home now forever. A lot of big businesses in New York City, Jess Staley, who's the CEO of Barclays Bank, they got a big 50-story office tower in Midtown with a couple of thousand employees in it. And they're now understanding, and this applies for all the Midtown Manhattan office buildings, the new social distancing rules are 2 people to an elevator. That's never going to work with a 60-story office building. And so what Jess Staley said is, our employees may never go back to that building, never go back to that building. That alone should tell you what an epic change is coming. And I want to use the word change. Yeah, it's going to be struggle in the beginning, but then we're going to change and we're going to come out of it. I do believe in human ingenuity, and I do believe we'll get past this if we allow the ingenuity to get past it. But if we keep throwing money at everybody and saying, no, don't change anything, stay that way, sit there and don't do anything. Here's $1,000 a week. Don't move. Don't look for a job. Then we're never going to get past this. And that's what my biggest concern is.
Yeah. How do you combine that with the fact that, just to your last point there, the government is basically paying people to stay home? So you have all these employers that are competing now with the government for these employees to produce goods and services.
That's a problem. It's a problem on two levels. One, if you look at Google search trends, you know what's not surging on Google search trends? In fact, I just tweeted it out from my colleagues at Arbor Data Science.
Is people searching?
Openings? Yeah, people searching for a job. No one is searching for a job on Google search trends.
Wow.
Now, part of that is that they probably conclude, rationally, now's not the time to be looking for a job because the economy's so bad. But I think part of that also is I'm getting paid $1,000 a week to not find a job. Why should I be busting my balls to go out there and find a job? And they're not. And that's going to be a real problem as we move forward from here. We need to restructure the economy. And restructuring the economy is not endless money printing and endless government bailouts of everybody. I get it. You got to get it for right now. It came on everybody fast. I get it. 40% of the public doesn't have $1,000 of savings. And most of those people, they got hit more with losing their jobs. You just don't want to cut them loose. I understand that. But that doesn't mean that they become a permanent ward of the state. Some point, we're going to have to end this. And some point, we're going to have to start the restructuring process. And it ain't going to be pretty. But I do believe that if you let it happen, it will happen fast in a period of a year, maybe 18 months would be my guess. But if you want to do like 2008 and string this out for 3, 4, 5 years because you just keep doing money printing, quantitative easing, government programs, that's when it's going to be, I think, more painful in the long term.
You know, the hard thing for me to reconcile is going back to the Austrian school. If you look at a recession, it's really considered the cure for all of the malinvestment and all the misallocation of resources, the excessive debt, et cetera. And I look at it like going to the gym. So if you go to the gym, it's not easy. It sucks. It's hard work. It's very difficult, but it makes you stronger, just like that recession makes the economy stronger. So if you can argue back in 2008 that we should have gone through a deeper recession to clean out the system, we tried to kick the can down the road, and that made the entire system more fragile to where we are today. How do you reconcile that view with the correct policy response in 2020?
That's a good question. It's a tough one, but you're right. We do need to kind of clean out the system. Let's go back to 2008. Remember we used to call QE unconventional policy?
Yeah,
now
exactly.
In 2020,
Extreme.
in 2020, the conventional part of it is the standard QE. The unconventional part of it is buying ETFs and corporate bonds. We keep this mission creep going and going. But what is the effect of all of that? Is the zombie companies that have been out there. A zombie company is basically a company that has more interest payments than earnings. That's like 15% of the companies out there right now. But we keep them afloat because we force interest rates down lower and lower, and in the case of Europe, negative, to kind of keep these companies going as well too. If you don't allow companies to bend and fold and shape and maybe fail and reborn, you're never going to get yourself a truly healthy system. I'll give you an example. We bailed out the auto industry in 2008. The auto industry in 2008 was failing largely because it needed to radically change. Well, we didn't allow it.
It needed to fail. It needed to restructure, right?
Right. And see, the problem is most people think that when you say the auto companies need to go bankrupt, they confuse that word with liquidation.
Right.
No, we're not going to liquidate them. And there's going to be a half-done car on an assembly line with weeds growing through the floor. We're still going to make cars. We're just going to make them in a different way. So by not allowing the auto industry to come and restructure, you give rise to a company like Tesla, which winds up becoming out of control bubble because it's competing with a bunch of zombies that could never make Tesla honest.
Right.
Tesla could never be made honest because the auto companies that they're competing with can never really are allowed to change. They still have to deal with all the legacies that they had because you never allowed that to change. We need companies to change. We need them to bend and fold. As much as it's terrible for taxi drivers, the Ubers of the world are a good thing in the long run. they also tend to be net producers of jobs. I understand, oh, but you make more as a taxi driver than you do as an Uber driver. Yeah, but there's 10,000 taxi drivers and there's 65,000 Uber drivers in New York City, at least pre-virus there was. And so it gives more opportunity for jobs. So we need to get about doing this. And when the Fed comes in with their programs, and when the Fed starts doing this, they are promoting a status quo. When we need the Schumpeter creative destruction to be happening at this point. And by promoting a status quo, and I understand, I want to emphasize again, yeah, I get it. You weren't supposed to take a bunch of people that made less than $40,000 a year and say, you're fine in February, you're done in March. It's hard. It's real hard to put that on them. So I get it. We need to help them a little bit along the way, but we need to get about going about this change. And every time I hear President Trump say, oh, we're going to boom like we never boomed before on the other side, what he's saying is we're going to go right back to 2019. I'd like to think that. It's just that when companies are being told that you never have to go back to the office again, for starters, it's already different. And it's not going to be 2019 under any circumstance.
Yeah, I'd like to go back to the early 1980s when our debt to GDP was 30% and the market cap to GDP was maybe 45%, calling it the Buffett indicator. I think that would be far more healthy, but that's just my opinion. Hey, can we discuss the CNBC interview that you tweeted the other day? I think
Sure.
you were on yesterday or the day prior, and I thought it was really interesting when you were talking about the Fed funds futures going into negative territory.
Yeah,
And then
so
also Japan too. I'm sorry. In that CNBC interview, you talked about Japan. I'd love to discuss that as well.
yeah, so Fed fund futures are, just a way for the market to express an opinion about where the Fed funds rate is going to be in the future. And by early next year, you're starting to see some numbers come up. Now, they're small. So they're starting to lean towards the idea that the Fed might go to negative interest rates. But again, the odds are very small, but I still think it's significant that we've crossed the Rubicon and that traders are willing to go and trade them into negative territory as well. So what does it mean if the Fed was to go to negative interest rates? That means the bank pays you. The financial system, bottom line it for you, the financial system was never built for negative interest rates. You can build a financial system for negative interest rates, just not the one we have right now. And that the banking system, the financial markets, the plumbing of the financial markets simply will not work properly with a negative rate. Now, we've had them in Europe and we've had them in Japan. And people say, but it did kind of function. Yeah, kind of dysfunctionally through the European financial system and the Japanese financial system, but they had a big out. The reserve currency of the United States was always positive.
Exactly.
Now, if you push us into that territory too, then you wind up pushing us into that negative system. Now, President Trump tweeted earlier this week, he called the negative rates a big gift. Sure, any levered real estate guy would think negative interest rates. You mean you're going to give me a boatload of money to build a building that no one needs, and then every month you're going to give me more money? That's what negative rates means? What a great idea. Sure. But the lender, the financial institution that's supposed to give you that money, they're going to go out of business. Now, maybe you think they're a bunch of banksters, and I'm not going to disagree with you that a bunch of them are, but it doesn't help us to wind up having the entire financial system crash and burn all around us because of negative interest rates. In Japan, where they went to negative interest rates, and here's the problem when you start pushing into negative interest rates. That's kind of an unnatural act. Markets, we've had interest rates for 5,000 years. Sidney Homer wrote a book that actually tracked interest rates back to 3000 BC. In fact, I've got that book somewhere in my office here. I'll find it later, but it's 700 pages in that book. There's nowhere in there is negative interest rates before 2014. And what that means is that a negative interest rate is kind of a government-directed thing. And when you start directing markets, where the government starts setting the rate in markets, you wind up what happened in Japan, and that is the day that the day that the Bank of Japan goes to QQE, qualitative quantitative easing, they said, okay, we're going to try and target the 10-year yield at 0. Okay, I'll be generous. The day you did it, that was probably close to the proper value. 4 years later, you're still targeting the same number. You never changed it. I think you've got the wrong level. You've chased the private sector out of the Japanese government bond market.
Right.
There are whole days where benchmark issues in Japan don't trade. It barely trades 10% of what it traded 10 years ago right now. Volume shrivels up and goes away. If the government's going to set the price, eventually, that even if you admit that the day they set it, it's the right price, eventually it will be at the wrong price. And when it's the wrong price, people are not going to be interested in transacting in that market. Oh yeah, there'll be sellers that think the price is too high or buyers that think the price is too low that want to do a trade, but no one will be on the other side of that trade. And that therefore the volume disappears and it goes away. This is the mistake that they make. The whole reason we have markets in price discovery is we don't know what the true value is. It's not a math equation. It's not an equation a bunch of bureaucrats in Washington can divine. It's the wisdom of the crowd, and we forever seek the proper level, and then we change our mind, and we seek it again, and we change our mind, and we seek it again. That's how markets allow us to be efficient. Can never be that way. The government is going to be running the show like we are dangerously getting close to right now.